Welcome guys, my name is Brahim, I'm a dividend investor. So today we're going to be talking about the different types of investing. There's three types of investing: growth, value, dividend. So first let's start with growth. Growth investing involves buying into companies with good future prospects. So what I mean by that, they're having increased revenue, increasing their income, and the profits are going up. So you're looking at a company that will essentially grow, and not in the short term, in the long term. For instance, you can take Microsoft. This is the chart of Microsoft's past 5 years performance. As you can see, Microsoft is a very solid company. It's actually in the top 5 highest market cap companies. So that was one example of a growth stock. An example of an industry that's full of growth stocks is actually the tech company, and that's why I listed Microsoft. The tech company is full of growth stocks. Value investing is the next type of investing. This involves finding companies that they have a strong track record, but they're just slightly undervalued. So what you're trying to work out is the intrinsic value versus its share price. And of course you're looking for the intrinsic value to be a lot higher than the share price is traded for. Now there's many ways you can calculate the intrinsic value, but there's not a specific number for its true intrinsic value. You can find a range, but you will not find a definitive value that will determine the share price it should be selling for. So let's give you an example. Let's say company X is trading for £20 a share, but its intrinsic value is actually £28 per share. Now you're looking at a potential 40% growth in the company if it does go to its intrinsic value. By finding a good company at such a low value, there's not so much downwards risk purely because it's undervalued, so there's more upside potential in growth. But in brief summary, you find a company that's trading lower than its intrinsic value. Last of all, we have dividend investing. Dividend investing is about buying companies and holding it for its dividend yield. Ideally, you're going to buy companies that are stable and probably blue chip companies. That doesn't mean you go to the hills and you start buying dividend stocks paying upwards of 10%, 12% just purely because of the yield, because that's not a safe, reliable dividend yield that you can hold on for the long term. With dividends, it's an idea of passive income. So let's say you put £1,000 into a company yielding 5%. From that 5% per annum, you expect to receive £50. And that £50 can be either reinvested into the company, withdrawn as cash, or you can choose to reinvest it into a different company. Now, with the dividends, the idea is you should be able to replace your current form of income. Of course, with dividend investing, you expect to see the share price fluctuate, either from gains to losses or losses to gains, and so forth. But the price of the stock shouldn't be your main concern. With dividend investing, you're looking at the long-term vision, which is passive income. So if you're looking for dividend investing, you're looking for the very long term. So that was a very brief summary on all three types of investing. I will do a video explaining all of them in much more detail, but I want to give you a brief summary of the three types of investing. Put in the comments down below the type of investor you are.